when growth happens at this pace, and compared to say the 1980s or 90s when a lot of the GDP growth was because of workforce addition, what we are seeing now is whatever growth is happening is a large part of this per capita addition, and basic necessities are taken care of. The growth in the discretionary items tends to happen really rapidly. So I think the current size of the middle class may be a lot smaller than the 140 crore people in the population. I think the prospects for growth of discretionary items as incomes grow, aspirations change, remains quite strong. So aggregate consumption, I think, may grow slower than overall GDP. The most categories which are discretionary in nature, I think the demand growth should be quite strong.
A lot has been said about the Indian consumer in the last few months or even the last few years. We've spoken about post-COVID, the K-shaped recovery, rising inequality, how the Indian consumer is in stress, and so on and so forth. There were a number of initiatives in the recent budget which seemingly seem to be aimed at the struggling Indian consumer and the middle class. So what is this Indian consumer and where are they today? How have they progressed over time? And what's in store going forward? Our topic of discussion today is this very exciting topic. Joining me today is Neelkanth Mishra. Neelkanth is the Chief Economist at Axis Bank. He is also the Chairman of UIDAI and is part of the Prime Minister's Economic Advisory Council. Neelkanth, welcome to the show.
Thank you, Samir.
So Neelkanth, let's first start by just putting in perspective the average Indian consumer. So what does this entity look like? What does this person look like? And particularly in terms of income levels, expenditure levels, etc.
So there is no average consumer. I mean, that what you learn very early when you start doing deeper work is that averages can be very misleading. Bottom 50% in 2012 consumed as much as the top 10%. Do simple averages in that group. The top 10% consumed 5 times as much, actually more than 5 times as much as the bottom 50%. That inequality is reduced a bit as per the recent surveys, but there is no average consumer. So one way to look at it and is to benchmark, and especially because most of our viewers are Indian, about 7.5% of Indian households, there are about 32 crore households, so 7.5% of Indian households own cars. So if you own a car, you're already in the top 10%. Everyone thinks they're middle class, but I think the definition of middle class is actually very different. About 48% of people own motorcycles. So if people who think that, motorcycle sales are a good reflection of the demand of the poor, are completely misleading the fact that the bottom half can't even afford a motorcycle. About, I think 40 odd percent, 42, 43, some number like that, own refrigerators. Air conditioners only 8%. Again, if you have an air conditioner in your house, that means that you are in the top 10% of the household. So there is no average Indian consumer, but consumption as a whole is, I think, a very important driver of growth. It has to be supplemented by income. So as you know, in GDP, there's the income side, there's the expenditure side. So on the expenditure side, about 60 odd percent is private consumption, or 30 odd percent is investment, the rest is government consumption and current account. So as people earn, they either invest or they consume, and so if they stop consuming, the economy slows down. But as we think about consumption, we have to also start thinking about incomes as to how the incomes are consumed. So both are blended together, but that's how I would look at consumption as a whole. And consumption is everything that you and I do on a daily basis. So we spend on food, we spend on clothing, we spend on services like education, health. If we live in rented accommodation, then rent is a big expenditure. We spend on conveyance, we spend on recreation, and so the net total of that is the consumption economy.
Sure. So one statistic that was, kind of at the back of one's mind, one always knows, but it was quite startling for me and eye-opening, is if you just look at the GDP data, GDP per capita in India is approximately, let's say, 2.3 lakh rupees. 2.3 lakh rupees is monthly 20,000 bucks.
Yeah.
Now, obviously, kind of this is at the per capita level. When you put households, then obviously this will kind of this will go up. But that's a good indication of, as you said, like you can't. There is no one consumer, but this is a good kind of an indication of the average Indian consumption. And along with the fact of
Sorry, if I may correct. So 60% of that is consumption.
yeah, so I meant good indicator of the Indian household or the Indian individual, let's say, of how much they are earning.
Yeah.
Right. Approximately 20,000 rupees a month is what people are kind of earning. And along with the other statistics you mentioned, which is ownership of cars, ownership of air conditioners, travel, etc., etc. It's a good kind of mental framework to kind of think about yourself. And I think, as you rightly said, like, when I grew up, I always used to think that I'm from the middle class. But kind of, I think, like nowadays, I tell people that if you went to school and you went to college, then very likely you are kind of not in the middle class.
You are upper middle class for sure.
Yeah. And I think it's kind of a good kind of way of thinking about this, because in our country, inequalities are quite stark. The couple of things that I thought will be helpful to get your steer on. The first one is, you mentioned this, that the inequality seems to have come down.
Consumption inequality.
And I think, particularly there was this recent household consumption survey as well. It looks like both, if you kind of looked at urban versus rural, that has actually quite starkly come down. The disparity has come down quite starkly. And also, if you looked at how much the top 5% is spending versus, let's say, the rest, that also seems to be kind of reducing. This is very counterintuitive in the sense that the narrative has always been we are in a K-shaped recovery, and the rich are becoming richer, and the inequality is widening, and so on and so forth. So what explains?
The first is that these consumption expenditure surveys also have to be taken with a pinch of salt.
Right.
Meaning that these surveys are only as accurate as the responses are. And global studies of inequality suggest that generally people tend to lie. Now, the percentage to which they lie also varies by income strata, but you should assume that they are reasonably consistent in lying. That it's not that they're lying more now than they did earlier. I mean, there's no way to predict that. But globally, it has been seen is that that the rich try to under-report their consumption because they're a bit embarrassed by how much they consume, and the poor tend to over-report their consumption because they're embarrassed at how little they consume. In India, there are newer layers that come because if you've done rural trips, you'll realize that people, even if they are better off, they see no merit in disclosing that they are better off. They actually would want people to think that they are in distress, so that, who knows, the government may throw some money at them, right? So there's a whole mix of incentives that go into the reporting of this data. The year-on-year trends between the HCES, the Household Consumption Expenditure Survey, which I believe what you're referring to, of 24 versus 23, those trends I think were counterintuitive to me also, because I don't understand how at a time when every other indicator is showing that inequality and consumption inequality is worsening. Forget about income inequality, but consumption inequality is worsening. That we saw a reduction, a further reduction in that. But the reduction that was reported between 2012 and 23 is something that was very intuitive to me. I think that is very consistent with what we observed. And the reason for that, and that also explains the rural versus urban divide narrowing, is that since 2011, there has been a remarkable improvement in rural quality of life. So, electrification in the 2011 census was only about 67-68%, and it has now jumped up to 97-98%. The availability of electricity has gone from 6 hours a day to 22 hours a day, 21 hours a day. The number of mud and thatch houses has fallen very sharply. Pakka houses have improved. Rural road connectivity has improved dramatically. Availability of toilets, availability of cooking gas, which helps save a lot of time and is better for health. piped water now increasingly. So with all of this happening, the quality of life has definitely improved significantly in rural areas, which is part of the reason why some workers don't want to come back to cities as well. While cities have also improved, they've not improved at the same pace. So the fact that if you are a rural housewife, now you can use mixer grinders to grind your masalas. The fact that now 40% plus of people or maybe nearly 40% of households have refrigerators. Now these are things that would not have been possible if electricity was patchy and very few people had it. So certain types of consumption actually get triggered by this. This also improves productivity. So the rural-urban divide narrowing is something which is quite intuitive. The consumption inequality ratio, what they call the Gini coefficient, it's a very, it's a very rough measure of inequality, but it's very commonly used, so everyone quotes it. So the consumption inequality also fell very meaningfully between 12 and 23. And I think the reasons for that were again that there were a lot of interventions which dramatically changed the productivity of rural workers and rural households. The access to phones, the access to roads improved the labor productivity, meaning that the friction in the job market came down quite sharply. So if you didn't have roads, if you didn't have phones, it took a very long time to even find a job. In fact, without a phone, imagine you're sitting in a village and it takes like several hours to get out of the village, and you don't have a phone. You don't even know where to go look for a job. With a phone, your utilization levels go up dramatically. So incomes have definitely improved, and therefore the low income consumer seeing, and then Narega brought much needed pricing power for labor. It improved the pricing power for labor, so they were not desperate enough at any point of time because there was always 100 rupees a day work available for 100 days a year. So all of that, I think, definitely improved the bargaining power of the lower income segments, and their consumption therefore grew faster. And as labor share of income increased, the capital share of income came down. This has reversed in the last couple of years, which is why the 24 versus 23 change is something that I find hard to explain, because you see telltale indicators like the earnings of listed companies are growing faster than nominal GDP, which is very consistent with the fact that rural wage growth in nominal terms is barely keeping up with inflation, which means that real wage growth is nearly zero. And therefore, and also the GDP growth has been investment driven. Basically, investment to GDP ratio is going up. And when most of these things happen, the capital share of income starts to rise. And because capital is owned by the top 10-20%, it generally means that consumption inequality worsens. And anecdotally also, this is very consistent because the sales of 250-liter plus refrigerators, larger cars, larger apartments, that has grown quite meaningfully. Now, I would not disregard survey data which surveys hundreds of thousands of households, but this last bit is something that I find a bit counterintuitive.
Sure. Thanks for that perspective. The other data point, just going back to the previous conversation, which was quite startling and which you have separately told me not fully to kind of believe as well, is this: if you look at the household consumption data and if you look at the top 5% households, their monthly expenditure of the household, not of the individual, of the household, is 20,000, like little 20,000 and some 300 rupees or something like that, right? And it's kind of quite startling, but yeah, I can.
No, but this is one. Remember that this is MPCE.
Yeah.
This is monthly per capita expenditure.
Right.
So you have to multiply by 5.
Okay, so it's not for the household, it's for
per capita.
okay.
It is per capita. That is one.
Right.
But more importantly, as we were discussing earlier, there's always been a gap between the aggregate consumption reported by the consumption expenditure survey and the consumption as reported in GDP.
Right.
So I remember when I was new to doing macro research, or at least in India, I noticed this discrepancy and I requested a meeting with the statistical office and met someone very senior. and I thought I was raising a very important question that look, if I add up all the 2012 data, I mean all the consumption, it still is 50-60% of, or some small percent of consumption as reported in GDP. So the senior officer in the NSO, so he had some juniors around him while we were meeting. He said, you know what, this was my project in 1981 when I joined, to reconcile the total consumption of the survey with the consumption as reported in GDP. So then I reviewed a book by Yogendra Alag. He was a great agricultural economist. And so this data has had discrepancies since 1971. What is striking though is that this gap has widened.
Right.
So now, if I remember right, the consumption expenditure survey, aggregate consumption is only half of what is reported in the GDP. So this is quite stark. There are certain types, like say for example rent. You will see that in urban areas about 7% of consumption in aggregate is reported as rent. That is just not true.
Right.
And I think
Obviously.
Mumbai, of course, it is very distorted. It's very high. But even in smaller cities, I think so. There are certain numbers that you can see are absolutely not correct. But it is a very comprehensive set of data, and therefore ballpark when you're looking at relative consumption or the split of consumption for a household, it is analytically useful. But year-on-year trends, I don't think are very useful.
Sure. So just coming back to the conversation on what's happening to the consumer. So one point you mentioned is that let's say 2012 to 23, kind of inequalities. I mean, at least the poorer section of the country seem to do quite well and grow and so on and so forth. That seems to have reversed. But then overall, there is a lot of noise around wage growth not being there, employment kind of being below what it ideally should be. So what's the reality? What's kind of really happening, and what's kind of data telling us?
So see, when you see this transition that for 10 years investment to GDP was falling, and now investment to GDP's ratio starts to rise, then the mental anchors people have to track what is GDP growth need to shift as well. So let me give you some examples. So about a year back, January last year, the CEOs of two of the largest FMCG companies, the fast-moving consumer goods and the consumer staples companies, reached out to me and said, look, the reported GDP growth is like 7% plus, but our volume growth is 2%. So one of them, in fact, called me and said, present to my board and explain to us why is it that GDP growth is if it is a 7, why my volume is growing at 2%. And the other CEO was also asking the same question.
And by the way, GDP is real and their growth is nominal.
No. We are talking real.
Nominal, okay.
Real. Yeah. So their nominal growth was 6-7,
right?
Maybe 4-5-6, but their volume growth was 2. So I explained to them that look, this is an investment-driven recovery. So if the investment to GDP ratio is say going from 30% to 34% over say 5 years, and so if it's just simple arithmetic that consumption to GDP ratio will fall, so GDP growth could be 7, the investment activity could be growing at 9 to 10, consumption activity would be growing at 4.5 to 5. This is just ratio, right? So instead of so what happens is the limestone that you dig out of the ground is being used to make cement and then build a house instead of make soap and then consumed. So if it's the real estate investment is going up, capital investment is going up. So a lot of the 7%, the same GDP, the constitution of that is different. So you need to look at different things when you are measuring GDP at that phase. So 7% GDP growth means that if it's investment driven, that consumption grows at 4.5 to 5. The second trend which is now happening is that as labor is in surplus and capital is in shortage, and which at this stage of development is a normal state of affairs, inequality tends to widen. So you can offset that by doing what we just discussed, that you have people who are living in mud huts, you move them into pakka houses, give them toilets, electricity, cooking gas, whatever. Now, but once that development stops, then their productivity growth has slowed, and therefore the labor share of income, because there's so many surplus workers in the economy, and then we've often discussed in our chats that there's no way India can create all the jobs that it must. So there are 10, 12 million, so 1.2 crore people who join the workforce or become of working age every year. On top of that, you have underemployment in agriculture, you have a very low female labor force participation rate, which is also increasing. So more and more workers are available, but there are not enough jobs. And you have still enough jobs to grow at 7%. So it is not that that there is not enough growth. It is that the growth needs to be 10-12% to create jobs for all these people. Now, in this situation, when the capital share of income is rising, because as you know, capital is owned only by the top 10-12%, 15%, the consumption inequality worsens, which is why you see luxury cars and luxury apartments, and as I was discussing earlier. And therefore, that same 4.5-5% is actually split into 8-10% growth at the upper income level, the top 10%, and 3% growth for the bottom 50%. Now, within that, of course, many of these businesses are also very susceptible to competition from the smaller manufacturers. So if you overprice yourself, which is what some of these companies have done, then you are vulnerable to getting attacked by smaller competitors who produce cheaper biscuits or cheaper soaps, and then at a rural level, local level, start taking market share. So that is why you go 2%. So now what has happened, because overall, because of the liquidity tightness, the fiscal problems that we discussed in earlier episodes, because the overall growth itself has fallen from 7.5 to about 5.5, 6, that 2% is now close to zero. So in the December quarter, most of the staples companies reported barely any volume growth. So, so while that is very worrying, this is not a trend that I expect will change materially. So as if with the suitable monetary and fiscal interventions, we are able to get growth back to 6.5-7%, the consumption growth, the volume growth for say FMCG may only grow to about 2%, 2.5%.
So Neelkanth, this is the mathematics is clear. You said if GDP is growing at 7 and if consumption share of GDP is falling, then obviously consumption should grow slower. But what's the science? Like why did consumption slow? Consumption should have grown. Like if GDP is growing at 7, that means incomes are growing, and so instead of GDP growing at 7 and consumption share falling and investment share rising, ideally investment should have risen and GDP should have grown faster and consumption should have continued.
GDP is growing faster now. So see, 7% growth is faster than what you were growing pre-COVID.
Right.
And it is investment driven.
Right.
Earlier, investment to GDP ratio fell from 34% to 27%.
Right.
And which is why consumption grew faster than investment. And people are anchored to that if GDP growth is happening, then consumption will grow. But now investments are picking up. So, okay, so let's now go one level deeper. When the real estate cycle truly turns, and I think we have discussed often that the quantum of spending on buying a house is bigger than the total spending on food and clothing over the lifetime of a family. That if you calculate how much your family spends on food, how much your family spends on clothing, and then multiply that by 30 years, meaning that the kids go get married or go to college and go start working, so they leave the house anyway. So the family household stays intact for about 30 years. And then you compare that to how much you spend on housing, or I spend on housing, or someone else does the same. 30 into food plus clothing is actually less than what you spend on a house. So if you buy a house, you're already making a big investment. And frankly, in that roti kapda makan equation, makan is very important. And which is why housing cycles, or in the real estate cycle, is a very important determinant of economic momentum in most large economies. So if you have spent on housing, your ability to spend on, like, what they say, that if you don't love your job, buy a house. Uh, it's more or less the same, right? So if you have a house, you have a mortgage, you are because you've invested in something big, you control your consumption. So if you want to boil it down to that level, I think those factors are at play as well.
Right. Understood. So now kind of we moving on a little bit. The other indicator that is spoken about a lot is how household leverage is moving as well. So household debt as a percentage of GDP has grown fairly meaningfully. Uh, and also the third indicator which people put along with this is the savings rate as well. So it looks like consumption is household consumption is slowing. Uh, at the same time, savings is also slowing and debt is going up. So what does how does all of this add up? What kind of is happening?
So let's look at them separately. So we'll come to savings, but let's first look at household debt. So I think there are three major changes that have occurred. The first is that there is a greater ability to disburse the kind of debt that is growing right now. So it is that you have proliferation of credit scores. So so the possibility to issue debt because of digital public infrastructure, availability of data, better quality technology. I mean, you drive that initiative. So I mean, that compared to 10 years back, we are much better positioned. We might still make mistakes, but we are much better positioned to issue debt at scale as a bank. And that holds true for the entire economy. So the ability to issue debt has definitely gone up. The second big change is that the willingness to take debt has also changed. And debt in that sense, is a 5,000, at least a 5,000-year-old product, maybe longer than that. Meaning that, Egyptian priests used to issue debt, and we have discussed that in some of our earlier episodes. And so, but the social norms around that, the acceptability of debt, or are you indebted, keep changing across through generations, and they're dependent not just on the mindset when you were growing up, but also on the social norms. So if all of your friends are taking on loans to consume or to buy a house or to buy a car, then it becomes socially acceptable to do that. If you're the only one doing it, then you won't, right? So these norms have changed. The fact that the current generation has not had the mental scars of slow growth and deprivation and desperation and periodic. See, when you're growing up, and every 5-6 years there is a recession or a sharp downturn or bout of high inflation and everything gets eroded, you grow up very cautiously. Whereas if you see a 30-year period of 7% growth, the mindset when you're growing up is that of taking on more risk, because you're much more sure about the future, perhaps, than you need to be. But so therefore, the younger generation, I think, has a greater propensity to take debt. And the third, and this will link to the savings part, is the flow of funds in the economy. See, in the economy, there are three major groups that exist. There is the government, the public sector, there is the private corporates, and there are the households. Now, the sum total of this, in terms of aggregate savings, is the current account deficit. Right? So your external. So if you think about the economy as a black box, if you are consuming more than you produce, then you have a current account deficit. If you produce more than you consume, which is what China does repeatedly, you have a current account surplus. So we have a current account deficit. Our current account deficit has actually shrunk over the past decade. So it used to be 3% during the taper tantrum of 2012-13, was 5% of GDP. Today it is 1% or less of GDP. At a time when one of the entities, which is the state, which is the government and the public sector, is actually a dissaver. So right. State plus central deficit is close to 7.5-8%, which means that one of these two is saving a lot more than they used to. Normally, not normally, when policymakers sit, it is about household saving and then investing and providing those savings for companies to invest and the government to dissave or basically to provide urban or whatever public services. But in the last 5-6 years, it has reversed. So the private corporates are the savers. Now, because their earnings are growing faster, their operating cash flows for the BSE 200 grew at 22% a year between FY19 and 24. When GDP growth would have been 8-9%, their operating cash flows, I'm not just talking profits, I'm talking the actual cash that they generated. So they have more cash to give. So this is just the flow. I mean, this is just an outcome that the households have a greater propensity to take debt because of the upbringing and whatnot. The banks now have better channels with credit scores and more data and all of that to give that debt. And the savings are now flowing through from the companies. So I see nothing wrong with this. There were pockets where there were bubbles forming, like unsecured personal loans or microfinance and all that, where I think there was excessive ebullience. But beyond that, I don't think the Indian consumer is in any way over-indebted. And if the corporates have high savings and they perhaps don't have the risk appetite or the avenues to invest right now, so having those savings channeled into household credit, I don't see macroeconomically anything wrong with that.
So your interpretation of this three things, which is slower growth in consumption, reduction in the savings rate and increase in the leverage, is that it's a phenomenon which is macroeconomic, as you said. It is not necessarily a sign of the household being in distress.
Some households, because if they take on a lot of debt, of course, will be in distress. But
Yeah.
so the inequality that we need to target, or not target, meaning that the policymakers need to be aware of, is that the capital share of income is growing faster. Companies are starting to save a lot more. Now, if they were to start investing a lot more, I think then some of these inequalities would start to get addressed through that channel.
Right.
So, because if they have a lot of savings, I mean, there's something that needs to happen.
Right.
If those savings are not channeled into consumption, then growth will slow even more.
Right. And so today what's happening is that, let's say there is only one company in the country, just to simplify this, that one company is making lots of cash flows and then it's going and saving it in terms of either it's keeping in its bank accounts or it is investing in government bonds or something of that
Yes.
nature. Versus, let's say, if they were to open up a new factory, then that savings would move from their bank account or their, whatever demat account or whatever, into some kind of spends, because to build a factory you have to spend, and those spends would then move to the consumers,
Yep.
who would then have more income, and then they would save or they would invest. So the private capex coming back is probably a way by which this situation could change.
Yeah, and private capex, I think, is starting to turn. So I would be wrong to say that it isn't. So the right way to do it, in fact, our estimate, and we have written a report on this, that because the real estate cycle is turning and the power generation cycle is turning, so these are the two biggest drivers of the investment cycle in any economy, that investment to GDP will keep going up. The demand for materials going into investment, like metals and cement and other materials, would necessitate more capex happening. And so we are seeing, the investing cash flows for the BSE 200 have been growing at 10% a year. At that pace, they need to keep growing for a while before they start to eat into their operating cash flows and they start taking on debt, which is the stage at which the savings in the economy, we can, if the current account deficit is blowing up, we have to start worrying about, are there enough savings in the economy. But till then, I don't worry about it. But when we think about private capex as well, I mean, one is of course their own risk appetite and their willingness to invest. But at the same time, I think it is very important to revive the availability of liquidity. So if growth was to come back to 6.5-7%, I think a lot of this equalization will start happening. You don't need active intervention of the type that, oh, now let's start taking some more taxes out of the corporates and start investing and deploying them in consumption or something like that.
Understood. So Neelkanth, then moving on to more kind of a very contemporary topic, which is in the recent budget, The government has changed the income tax structure. And again, this is something that has been spoken about a lot. 1 lakh crores of income taxes have been, kind of the government's income is expected to relatively reduce by 1 lakh crores. So that's more money in the
So tax
hands of the
forgone.
consumers.
Yeah.
Tax forgone is 1 lakh crores, and that's money in the hands of consumers, and so on and so forth. In your mind, what does this do?
So let's okay. So let me first explain what this does, and then I'll run into why possibly something like this was done and what the macro implications are. So I don't think this is a consumption stimulus. I mean, the day of the budget, the consumption stocks flew Monday. I mean, they did again. Thankfully, after that, there was a bit of realization. I don't know, but conceptually, this was not the right thing to do. See, when a government fiscal deficit shrinks, which is what the government has announced it will do, 4.8 going to 4.4, I think was the right thing to do. We have to get the long-term cost of capital down. Debt to GDP for the government is still very high. That consolidation is very important. Whether rating agencies change their mind or not is irrelevant. The point is that the government needs to show that path for overall macro stability, which I think is a great thing. So the aggregate or the impact on aggregate demand because of the government is negative. Now, capex to GDP is going to be unchanged. So the capex growth is about 10.1%. Nominal GDP was assumed is also 10.1%, which means that everything which is not capex, there is a decline. And you see that expenditure to GDP is also declining. So there is a negative consumption stimulus at an aggregate level. In fact, if you want to get down to the personal income tax as well, personal income tax collection assumed in the budget is plus 14%, which means that it is growing faster than nominal GDP, which means that the government, despite this 1 lakh crore of tax giveaway or tax forgone, is actually still expecting to get more from personal income taxes than the growth in the nominal GDP. So effectively what is happening is that because of better compliance, because of the proliferation of data, transparency, formalization, the government's ability to collect taxes has improved. The government is now giving it back to some of the most loyal of the taxpayers. That is effectively what I think has happened, that personal income tax to GDP has grown dramatically. See, between 2001 and 2019, personal income tax to GDP rose at about 5 basis points a year. This is the normal state of affairs as any economy becomes prosperous, its ability to collect taxes, the people's ability to pay taxes all improve. So this is a very normal trajectory. Since 2019, this ratio has risen at 20 basis points a year. So what used to be 5 basis points has become 20 basis points. So there is a lot of tax a lot of the fiscal consolidation, a lot of the infrastructure development that has happened over the past 5-6 years has been funded by these taxpayers. Now this year, the government, I think, was realizing that there are limits to how much capex it can do. There's only so much national highways that you can build. Railways could have absorbed more capex, but they also have spending issues. Defense, there is only a certain pace at which you can grow. Beyond that, the central government doesn't have any avenues to invest in capex. So if you have and you think that you have these 1 lakh crores, what do you do with it? Because the most productive use is to do it on capex, but you know that there are absorption issues on the capex side. So you might as well give it back to reduce distortion in the economy from where this money is coming, right? And you give it to the people who actually pay taxes. So this benefit only goes to those 70-75 lakh people who fall into that bracket, or 12 to 50 lakhs. That's our estimate of segment that is the most that benefits the most from this. The interesting thing is that this only benefits people who actually pay taxes. So there is that. It's a small set, but they are the ones who have been funding the rest of the government. So no one should have any complaints on you're benefiting them. But those are the guys who are paying taxes, paying for everyone else's benefit. So So I think that's how I would interpret this. This is not a consumption stimulus. It helps consumption for that bracket, but overall consumption does not really benefit from this. The capex to GDP remains flat. So whatever the government was doing in terms of infrastructure building, etc., persists in that direction.
Great. So just Neelkanth, just bring all of this together. What you're saying is that if you think of the consumption stimulus coming from the budget, basically if the government spends more, that is more consumption stimulus, because that money will finally go and sit in some consumers'
So the
pockets.
government borrows from the future, because when government has a fiscal deficit, it's borrowing from the future.
And it spends today.
Yes.
And when it spends today, that money goes into, finally it makes its way into people's bank accounts. And when people have more money in the bank accounts, they'll spend more. What India has been doing consistently actually now is that actually its fiscal deficit, which is basically how much they are spending and how much they are borrowing from the future and spending now, actually has fallen very sharply over the last 3-4, post-COVID, post kind of the recovery from COVID, when our kind of fiscal deficit went through the roof because the government had to spend. But after that, the government has materially reduced the fiscal deficit year on year. And that, just by its nature, actually is it's kind of a deflationary effect on the consumption. Right? Like consumption goes down.
Depresses consumption.
Depresses consumption.
Deflation is a stronger word.
Yeah, sure. It has a depressional effect on consumption. And so this 1 lakh crore that the government has given back, frankly, doesn't matter, because in the overall scheme of things, the government is spending less. And so maybe this small small consumer base does get benefited, and they will obviously spend more and so on and so forth. But from a economic perspective, actually not much has changed last year versus this year.
Correct.
And the third, by the way, this is a third statistic that is also quite interesting and baffling, is the statistic that you mentioned, which is the number of people who are going to be benefited by this is in the tens of lakhs. It's like 50 lakh, 60 lakh, whatever, 70 lakh, let's say a crore.
No, so the good thing is that because the only people who benefit are the people who pay taxes.
Yes.
And the direct tax statistic data is available.
Yes.
So in FY23, so we did some estimate of, based on the changes, who benefits how much. So 70% of the benefit goes to people earning between 12 lakhs and 50 lakhs. Reasonable number is below that, because till 12 lakhs you have to pay no taxes now. But so this number, 12 to 50 lakh, people who report incomes 12 to 50 lakhs, was about 58 lakhs in FY23. That's the last year data that we have. Assume that that number has grown, because FY26 is like 3 years from then. So that 58 becomes 70 lakhs. So maybe 75 lakhs if you're very...
Yeah, sure. And there are some people who are between that 7 lakh to 12 lakh who kind of go out. So maybe let's say it's a crore, right? And let's say there is under reporting of incomes anyways.
See, the people 7 lakh, 12 lakh were not paying much taxes. So while they will benefit.
Yeah, but not by a lot.
Yeah, by a lot. So 70% of that 1 lakh crore will actually go to this 12 to 50 lakhs segment.
Sure. I was going on a different point, Neelkanth, which is I go back to a few data points that we mentioned, which is 2.3 lakh per capita income and 20,000 rupee consumption and so on and so forth. 7% car penetration, 8% air conditioning penetration, and add to that the fact that the number of people who are paying tax, who are in this bucket, is, let's say, a crore, which is less than 1% of India's population.
Yeah.
And so if you are paying taxes, you are already, in the 1%.
Yeah.
Maybe not one. Let's say there is, people are underreporting and so on.
They are.
So let's say that is 3x or that is 5x. So you are still in the top 5% of India's population. And again, kind of just to put this perspective on what middle class in India generally looks like. So we spoke about the income tax stuff that has happened just now. There is also, in the recent monetary policy, a few things have happened. So one, obviously there is a 25 basis points reduction in the interest rates. And also there are lots of, kind of, the central bank has quite, I would say, with intent spoken about, bringing liquidity back, being focused on growth, and that the balance between growth and inflation has now moved a little bit, etc. What does all of this imply?
No, this is very important. So I'm not sure the rate cut will help immediately, because with this kind of a liquidity situation where there is 6 lakh crores that banks are borrowing from through CDs, and we have this absolutely crazy situation where the repo rate was 6.5, but the 1 year borrowing rate for most banks was 7.6% or 7.8%. This is ridiculously high, right? So the 6.5 going to 6.25, the CD rates remain at 760, 780. There is no benefit to anyone, and so how will the banks pass on the rate cuts, right? So it's very important that the governor signal that we will endeavor to provide as much liquidity as is needed. And it'll be interesting to see how they go about doing this. Because I think one of the reasons that markets were a bit disappointed was that while that commitment came, and they were also expecting announcements about how to solve for the durable liquidity, but the governor has given a guidance, and one should assume that the RBI will act on it. What was even more important and interesting for me is that he explicitly talked about the costs of regulation. So what had started to happen as India's GDP growth accelerated is that most regulators in India had started to become highly risk averse, and they were starting to clamp down on this and that and tighten regulations and this and that. The fact that you need to take some risk to grow is something that is now clearly coming through, and I think the governor explicitly talking about how they will start to back off from excessive regulation is something that is also welcome. And the reason why this is important is that if your growth is well below what your trend growth should be, which is I think 7%, but if you're growing at 5.5%, 6%, which I think what we are likely to have done in the September and December quarter, you need a cyclical boost, because your structural trend growth is there. I mean, so you have labor input, capital input, because your real estate cycle is turning, power sector cycle is turning, and your productivity growth is strong. So why are you growing slower? Because of the problems I just mentioned, that you have fiscal consolidation happening. On top of that, you've kept monetary conditions so tight that your short-term funding rate for banks is way above what the overnight repo rate is. And so the only way to solve for this is to actually ease and try to create more credit growth, because you can't do a fiscal stimulus because the government still has high debt to GDP and they have to reduce their fiscal deficit. You have limited room to bring down cost of money because 25 basis points has happened, maybe there's another 25 basis point that will happen. But beyond that, if your inflation is going to be 4.5, it's going to be harder and harder to justify further cuts from that, which means that the only way to revive growth is to get credit up from 11% to say 14, 15%. So a very important driver of growth, which we have, the growth slowdown, which we had discussed in our earlier episodes, has been credit growth falling from 17 to 11. So unless you can get it up to 14, 15, it's going to be very hard for overall economy to revive. So, so providing liquidity, easing regulation, and I would say that even some macroprudential easing, like reducing risk weights on certain types of loans where the RBI sees low risk, they're all going to be necessary for growth to revive.
Right. So, so fiscal side, kind of becomes tighter in the sense deficit reduces, hence consumption impact is negative. But the monetary policy and the monetary side seems to be kind of, it was quite tight actually historically for the last, I would say 2-3 years actually. It is starting to become more, accommodative, quote unquote. Though the stance continues to be neutral, but I'm using kind of all kinds of words, so please apologize for that. But it has become, I would say, more considerate towards growth, and so the consumption boost could come from the credit growth, and from.
So more than consumption growth, I would say growth would the boost to growth would come from that. And I think at this stage where the price to income ratios in real estate are much more conducive for people to buy houses, those are the areas where I think new catalysts can come through.
Fantastic. So, Neelkanth, it was a great conversation. I think for me, I think a few takeaways. One, kind of the picture we have in our mind of the quote unquote average Indian consumer or the Indian household. It's great to put that in perspective. 7%, 8% penetration of cars, air conditioners, less than whatever 1.5%, 2% of people who are paying taxes. Average per capita GDP itself of 2.3 lakh crores, which means average per capita consumption of about 1.4 lakh crores, 1.4 lakh rupees annually. So, monthly it's like little over 10,000 rupees. So, kind of the Indian middle class is not what popularly is perceived as. So that's kind of number one. Number two, actually India has done quite well in terms of income and consumption growth for its poorer population. Between 12 to 23, we saw fairly good growth. That has turned as the GDP cycle has turned from being consumption driven to investment driven. So we have seen in the last 2-3 years, we've seen kind of that shifting. Consumption is, there is no average Indian consumer. It's very different by parts. And you expect to continue to see this consumption-led growth being, because the investment kind of will continue to be higher. The consumption part of the GDP continues to shrink, which obviously means that households are consuming at a slower pace. And one of the driving forces for that is just the fact that India is consolidating its fiscal position. India had to spend quite significantly during COVID, when the government has a responsibility towards its citizens in situations like that. So they've spent, but they are now consolidating so that should, quote, touch wood it won't, but should another event of this nature happen, they have the power to at that point again go back and spend. So this is prudent to do. But conversely, what that means is that it has a negative impact on consumption. And despite the 1 lakh crore tax foregoing that has been announced in the budget, the reality is that actually the budget is, because the fiscal deficit is going to come down quite sharply by 40 basis points is very significant reduction in the fiscal deficit. And because it's going to do that, that will have a negative drive on consumption growth itself. On the monetary side, things seem to be turning. The RBI has cut the rate, but more importantly, they've kind of spoken and they've shown their intent on easing liquidity and being focused on growth, thinking about the balance between growth and regulation. And they've explicitly said that this kind of growth versus inflation and stability balance has now shifted a little bit, and so they want to focus on the other side, which means that the monetary aspect of this is likely to be more conducive, and so growth could come from there. As always, a great conversation.
I just want to just take another minute to run through this middle class question that you raised. A point that you raised. I think that's right. It is maybe currently smaller than what most people think it is, but remember that when growth happens at this pace, compared to say the 1980s or 90s, when a lot of the GDP growth was because of workforce addition, what we are seeing now is whatever growth is happening is a large part of this per capita addition. And basic necessities are taken care of. The growth in the discretionary items tends to happen, of course, really rapidly. So while I think the current size of the middle class may be a lot smaller than the 140 crore people in the population, I think the prospects for growth of discretionary items as incomes grow, aspirations change, remains quite strong. So I don't want to convert this into what the Indian consumption story is over. That would be the
of course not
to give. So aggregate consumption, I think may grow slower than overall GDP, but for certain categories, the most categories which are discretionary in nature, I think the demand growth should be quite strong.
Yep. Thank you for that conversation, Neelkanth.
Thank you.
And I hope you liked it as much as
yes, I did. Thank you.
Thank you for listening into this episode of Open Dialogue. I hope you enjoyed this as much as we've enjoyed bringing it to you. We are overwhelmed by the response that we've received and really look forward to your comments and feedback. Do like and subscribe to our channel to keep track of new episodes that are coming through. Thank you.